The 21st century was supposed to be an age of innovation and prosperity. Instead, it turned into a perfect playground for the most shocking financial scams the world has ever seen. Enron. Enron began as a pipeline company, but reinvented itself as an energy trading giant. The company hid losses and debt through shell entities and used accounting tricks to record expected future profits as if they were already earned. For years, investors believed Enron was one of the most successful companies in America. In the early 2000s, the truth came out, and the company collapsed almost overnight. The stock fell from nearly $90 to under $1, wiping out about $75 billion in shareholder value. Thousands of employees lost their jobs and retirement savings. The fallout was so severe that Congress passed new corporate accountability laws to prevent similar scandals. The scandal became a textbook case in business schools around the world. It also destroyed confidence in one of the world's largest auditing firms, Arthur Andersen, which was implicated in the cover-up. WorldCom. WorldCom was one of the largest telecom firms in the United States, but it collapsed in disgrace after one of the biggest accounting scandals in history. Executives improperly classified billions in regular operating expenses as long-term investments, which made profits look much larger than they were. In reality, the company was losing money. When the fraud was revealed, WorldCom filed for bankruptcy, and over 30,000 employees lost their jobs. Shareholders lost billions, and CEO Bernie Ebbers was sentenced to prison. The case highlighted the ease with which accounting rules could be abused to mislead investors and regulators. The collapse also forced stricter scrutiny of accounting practices across all publicly traded companies. It remains a warning of how unchecked executive ambition can destroy entire industries. Bernie Madoff. Bernie Madoff ran the largest Ponzi scheme in history. For nearly 30 years, he promised steady returns and used money from new investors to pay older ones. The scheme grew to nearly $65 billion before collapsing during the financial crisis when too many investors asked for their money back. Madoff targeted wealthy individuals, charities, and communities that trusted him. Despite repeated warnings from analysts, regulators failed to act for years. When it finally fell apart, thousands of people lost their life savings and many charities were forced to shut down. Madoff was sentenced to 150 years in prison, but the damage to victims could never be undone. The scandal exposed the failure of regulators to act on credible warnings. It also became a symbol of how greed and trust can intertwine to devastating effect. Subprime mortgage crisis. In the early 2000s, banks issued risky mortgages to people with little chance of repayment. These loans were bundled into financial products that were rated as safe by credit agencies, even though they were highly unstable. When housing prices stopped rising, millions of homeowners defaulted, and the system collapsed. The crisis destroyed around $10 trillion in housing value, caused millions of foreclosures, and led to a global financial meltdown that cost tens of millions of jobs worldwide. Despite the scale of the disaster, very few executives faced prison time, and many banks received government bailouts. The scandal exposed deep flaws in the financial system and the role of regulators who failed to intervene. It also reshaped global banking laws, leading to stricter rules under reforms like Dodd-Frank. Stanford Financial Group. Alan Stanford ran a Ponzi scheme worth around $7 billion through certificates of deposit sold by his offshore bank. Investors believed they were buying safe savings products, but the money was used to fund his extravagant lifestyle, including private jets, real estate, and even a professional sports team. Regulators had suspected problems for over a decade but failed to act. When the scheme collapsed, victims recovered only a fraction of their investments. Stanford was sentenced to over 100 years in prison, but thousands of retirees and families had already lost their life savings. The scandal revealed glaring gaps in cross-border financial regulation. It also highlighted how fraudsters often target ordinary people by exploiting their trust in supposedly stable investments. Wells Fargo. Wells Fargo became infamous for creating millions of fake accounts without customers' consent. Employees, under pressure to meet aggressive sales targets, opened unauthorized checking accounts, credit cards, and other products, sometimes charging fees on them. Whistleblowers inside the company were ignored or punished. The fraud lasted for years before coming to light. Wells Fargo eventually paid billions in fines and settlements, but the scandal damaged its reputation and revealed how a toxic corporate culture could push employees into widespread misconduct. The episode showed how systemic pressure can drive unethical behavior on a massive scale. It also fueled debates about the accountability of top executives in corporate scandals. Martin Shkreli. Martin Shkreli became known for raising the price of Daraprim, a life-saving drug, from under $15 to over $700 per pill. The move was legal under American pharmaceutical pricing laws, but it sparked outrage as patients and hospitals were forced to pay exorbitant amounts. Shkreli was eventually convicted, not for price gouging, but for unrelated securities fraud connected to his hedge funds. His case highlighted how existing laws allowed companies to dramatically inflate drug prices without breaking any rules, leaving patients vulnerable to extreme costs. His public arrogance and defiance made him a symbol of unchecked corporate greed. The scandal also triggered discussions about urgent reforms in drug pricing and healthcare regulation. 1MDB scandal. One Malaysia Development Berhad, or 1MDB, was a state investment fund meant to support economic development. Instead, billions were stolen by then Prime Minister Najib Razak and his associates. The money was used to purchase luxury real estate, yachts, jewelry, and even to finance a Hollywood movie. Major banks, such as Goldman Sachs, helped raise money for the fund and earned large fees while ignoring warning signs. The scandal became one of the biggest cases of government corruption in history. Najib Razak was sentenced to prison, but much of the stolen money remains unrecovered. Theranos. Elizabeth Holmes founded Theranos, claiming to have developed blood testing technology that required only a finger prick. Investors contributed hundreds of millions, and Walgreens partnered to roll out testing centers. In reality, the technology did not work, and patients received inaccurate results that endangered their health. Employees who raised concerns were silenced or threatened. Journalists eventually exposed the truth, and Theranos collapsed. Holmes was convicted of fraud and sentenced to prison. The scandal not only misled investors but also risked patient safety on a massive scale. It became a landmark case, showing how media hype and Silicon Valley culture can blind even seasoned investors. The fallout also raised urgent questions about the need for stricter oversight in health tech startups. Wirecard. Wirecard was celebrated as a German fintech success story and became part of the country's most prestigious stock index. The company claimed to hold over $2 billion in cash that did not exist. For years, journalists raised questions, but regulators failed to investigate the company and instead targeted reporters. When the fraud was uncovered, Wirecard collapsed rapidly. The CEO was arrested, while the COO disappeared and remains at large. One of the world's top accounting firms was discredited for failing to detect the fraud, despite auditing Wirecard for years. The scandal was a national embarrassment for Germany, damaging confidence in its regulatory system. It also highlighted how financial watchdogs can sometimes protect corporate power instead of protecting the public. Archegos Capital. Archegos Capital, run by Bill Hwang, used borrowed money and complex financial instruments to secretly build enormous positions in a small number of stocks. Multiple banks unknowingly extended credit for the same trades, believing their exposure was limited. When the stock prices turned against him, Archegos collapsed in less than 2 weeks. The fallout cost major banks billions of dollars, with Credit Suisse losing more than $5 billion alone. Although not technically fraud, the collapse highlighted how hidden leverage and reckless risk-taking can destabilize global markets. The debacle exposed glaring weaknesses in how financial institutions assess counterparty risk. It also sparked regulatory calls for stricter oversight of family offices and opaque investment structures. Volkswagen Dieselgate. Volkswagen marketed its diesel cars as environmentally friendly, while secretly installing software that manipulated emissions tests. During official testing, the cars appeared compliant, but in real driving conditions, they emitted pollutants at levels many times higher than legal limits. Regulators uncovered the deception in 2015, and Volkswagen faced billions in fines, lawsuits, and recalls. The scandal destroyed the company's reputation for trust and quality. It became one of the largest corporate frauds in the automotive industry and a major environmental scandal. Beyond financial penalties, the scandal accelerated a global shift toward electric vehicles. Volkswagen has since invested heavily in clean energy technology, but the trust it lost has been far harder to recover. LIBOR manipulation. The London Interbank Offered Rate, or LIBOR, was a benchmark interest rate used to set the cost of loans worldwide. Traders at major banks secretly colluded to manipulate the rate for their own financial gain. The manipulation affected everything from mortgages to student loans and impacted trillions of dollars in global financial contracts. When regulators discovered the scheme, several banks paid large fines, and some traders were imprisoned. The scandal revealed how a small group of individuals could exploit a critical financial benchmark and affect millions of people around the world. It also undermined public trust in global banking systems at a time when confidence was already fragile. In the aftermath, LIBOR was eventually phased out and replaced with alternative benchmarks to prevent similar abuses. Luckin Coffee. Luckin Coffee in China was promoted as a rising competitor to Starbucks, expanding rapidly and attracting billions in investor funding. In 2020, it was revealed that executives had fabricated hundreds of millions of dollars in sales to make the company appear more successful. When the fraud came to light, the stock collapsed, wiping out billions in shareholder value. The company admitted to the misconduct, and several executives faced criminal charges. The case underscored the risks of chasing rapid growth without verifying reported results. The scandal also sent shockwaves through global markets, making investors more cautious about Chinese companies listed abroad. Despite the fraud, Luckin later restructured and surprisingly returned to profitability, though its credibility remains deeply damaged. FTX and Sam Bankman-Fried. FTX was presented as a trustworthy cryptocurrency exchange, but secretly misused billions in customer funds. Sam Bankman-Fried directed deposits to his trading firm, Alameda Research, where the money was used for risky bets, luxury purchases, and political contributions. When cryptocurrency markets dropped, customers attempted to withdraw funds, but the money was gone. The exchange collapsed, leaving investors with massive losses totaling around $8 billion. Bankman-Fried was later convicted of fraud. The scandal became one of the most damaging events in cryptocurrency history and a warning about the dangers of unregulated markets. From Enron to FTX, the 21st century has delivered one financial scandal after another. Different industries, different faces, but the playbook rarely changes.